Why do most investors underperform the market? Is it because of, the market turning against them, foreign events, politics, interest rates, what the Fed's doing? Not likely. It's actually investors' emotional decisions or bias. That is the leading factor that drives the two divides in investment planning, investment management. You have active investors and passive investors. Active investors are moving and trying to predict what the market's going to do, buying and selling. Passive investors will pick an index or a fund or an individual set of holdings and hold those for a long term. So if you're an active investor, chances are you're going to underperform the market because of your biases. And these are your emotional decisions. For example, whenever COVID hit, if a lot of people moved out of the market at that point because we were out of work for a solid year, right? Living at home, and within a year afterwards, the market went up 120%. Same thing with AI. The AI bubble, there's a lot of commentary that we're in another apocalyptic scenario. AI is going to end all the jobs and nobody's going to have any work anymore. But reality, maybe it is a bubble, maybe it's not. But right now, the market has been going just fine. So investing is not really random. The short-term performance of the market is kind of random. Long-term, it trends upward over time. It just does. It goes up, and it has for 100 years. Now, if you miss the top 10 days of a market rally, you're hurt. And it turns out that these days, even though the market performance is random, especially on the short term, these 10 days are sometimes not random. They're clustered, and they tend to be clustered around the negative days. So if you allow your biases to take charge, you're going to be run out of the market, right? And the only way to make money in stocks is to be invested, stay invested, have a strategy, stick with the strategy. Okay, so here's an interesting fact. Over the last 30 years, if you missed the top 10 days of performance, your returns are going to be cut in half. That's how significant this is. It's a real loss. That's why staying in the market matters. Market timing rarely works. And the reason why is number one, you got to be right twice. You got to know when to get out and when to get back in. You got to be right on the in and the out consistently to be an active trader. And it's difficult. That's why I would argue that a modified passive strategy is probably the best strategy. So there's a concept called the investment return versus the investor return. So we can look at what the S&P 500 has returned over a period of time. And you can look at what a typical investor that's investing in a similar portfolio as the S&P 500. There's going to be a significant drop in what the difference between investment return and investor return. The investor is going to deal with biases, costs, taxes, expenses, missing some of the top days, and the end result is about a 4% delta. So it's the active investor is going to be short about 4% over the passive investment. The difference between an active and a passive investor, the passive investor will create a portfolio, let's just say it's an index portfolio, and let it ride, rarely making changes. The active investor is attempting to time the market, pick individual securities, and the whole time what really matters is time in the market, not timing the market. So active investors tend to underperform passive investors because of human emotions. And the academics created a term for that. It's called biases. And everybody has biases. And some of the examples of biases for investors, especially active trader, loss aversion, overconfidence, herding, recency bias, familiarity bias. There's 30 or 40 biases, and that's the top 5 that we need to be aware of. Now, for an investor to overcome this, they have to keep their emotional balance in check. And all along, the passive investor, what they need to do is basically just stick with the plan, stay with the plan, whereas the active trader's got to deal with a lot of emotional baggage in making decisions about when to buy, when to sell, when to hold. For example, loss aversion. Like, let's pick COVID, for example. If you're an active trader and all of a sudden you've lost 30% of your market, a active trader is going to go, well, human reaction says, I need to do something. And the passive investor is going to go, maybe I should go play a round of golf and, take out the grandkids or go play with the family or the dog, but I don't have to take action. And that action is the delta. It's what makes the difference between success as a passive investor or underperformance as an active investor. In general, it's not always the case, but that's the rules. So the truth is, the way to succeed in investing is to have a plan, stick with it. Don't pay attention to the noise. The noise is what's on the financial news, the financial newsletters, that their objective is to sell you things. And really, the right answer for you is to stay the course. So if you want an edge on other investors, stay the course. If you want to have a better return, be a disciplined investor. Have a plan, stick with the plan. Regular rebalancing, indexing, all leads to success. And passive has a strong argument over active investments for most individual investors. I would suggest everybody seriously give it a shot. It's the way to success. My suggestion to you is to work with a financial advisor so you can quantify the facts, the goals, the plan, develop a plan, and then from that plan, you need to back into what your investment strategy should be. How much risk tolerance you have, what your allocation should be, and then from that, you devise your investment strategy. It can be the tactics from there. So have a plan, have an investment strategy, and then stick with it. But have it regularly updated, regularly reviewed, and you'll do fine. If you have any questions or concerns, feel free to go to the website, Hamilton Financial Planning, or leave us a comment in below, and we'll get right back with you. And also feel free to give me a call anytime. Thank you.